Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the US dollar is still on an upwards trend. We have a plus 75 score for the US dollar index. I think the US dollar index will continue this upwards trend throughout the year of 2012. The main reason why I believe this to be the case is that European investors are going to flock in to U.S. treasuries and perhaps U.S. non-cyclical stocks. The main reason why I see this investment behavior playing out is because people don't feel that safe buying into 10-year obligations that may end up worthless if the governments that issued those loans were to default. And for us to be reassured at this point, since interest rates are trading near record highs of 7 to 6% depending on the PIGS state you're talking about, some are even trading at 30%, which in those case scenarios, those governments are already bust. You know, they're going to default. And that also includes Ireland and Greece on the really far end of the scale. But when we're talking about the elephants, which is Spain and Italy, the only way you could really reassure markets and make us feel secure is under the case scenario where the countries start paying off their account balance. So basically the amount of debt on the European government books, specifically Italy and Spain, starts to reduce, and we start to see a positive account. We start to see the account balance decrease. It doesn't mean we have a positive account balance, but at least the account balance, the amount of liabilities on the Italian government's balance sheet starts to recede, and that will reassure markets. Now, how long will that take? Well, it might take 2, maybe even 3 years for the cuts to fully take place. And as cuts start taking place, public sector employment continues to drop, and as public sector employment drops, gross domestic product decreases, tax revenues drop, and spending cuts have to continue. They have to keep chopping off different portions of the government, keep cutting back on social benefit programs, all sorts of stuff, until they are eventually at a point where their budget, their account balances start to decrease, and that means liabilities are pulling back. Now, and therefore, a lot of analysts are thinking we might have a 2, 3, maybe even a 4-year recession in the PIGS and the Eurozone collectively. So the European economic bloc is in a lot of trouble as it is highly leveraged. Pulling back that leverage means less government spending, and that will hurt the economic zone. Therefore, a lot of people are buying into euros, and they are also buying into the Japanese yen as well. So we're seeing this in the Euro Japanese yen and the Euro US dollar. Now, because of that, I want to just think of a basic idea of where this market could eventually bottom out at. Well, the first time it broke its 200-day moving average back into the 2008 financial crisis, where the euro was seen as an inferior currency to the Japanese yen in terms of stability and safety. At that point, at its highs, it was at around 155. That's where it first broke the 200-day moving average and eventually bottomed out and found support at around 115. So 115 minus 155, and that right there is around a 35. I think 35. 15. No, 40. Yeah, 40. So we're looking at around a 40 spread difference. So 40. 40, 40. So we got 40, and basically, if based on the fact that that it broke down at 115, not so coincidentally, look at it right here. 200-day moving average breakdown, 200-day moving. This is the area where the markets eventually find some support. 40 pips below, 40 points below the first break of the 200-day moving average, and now we're looking back at another crisis. And this could just be another 40 pips, or 40 points actually lower. So 40 points, you subtract 40 from 115, and what does that mean? Well, you take away 15, that's, 25 left, I guess. and subtract 25 from 100, and that's 75. So perhaps the most this market could fall is 75 based on past performance. So 75 could be our target exit zone for the Euro Japanese yen before it eventually finds a multi-year support. How long that support lasts depends heavily on whether or not Italy and Spain accomplishes an account balance where they're not losing more money than what they're taking in as tax revenue. If they can accomplish a positive account balance, that would mean the Japanese yen and the Euro Japanese yen would eventually reverse, and the Euro would have a nice multi-year rally. But until then, we have to be bearish the Euro Japanese yen and continue to see Euro outflow, Euro outflow, and see it invested into the Japanese Treasury bond market and Japanese equities. Same thing for the Euro US dollar, except the Euro US dollar could also be on a multi-year downtrend. How long? I'm not exactly certain, but the main cues to look out for is a positive account balance on both the Italian and Spanish government balance sheet. Okay, so that, and a positive account balance means that the government is bringing in more in tax revenue than what is spending on all of its liabilities and expenses. If it can just cover those expenses, that would mean that bond investors would be more willing to buy into bond notes, and that would bring security to the European economic bloc as a whole. Now, because I think that this trend is still on a downward trend and we are dealing with a bear flag pattern, chances are, this area of support at 127 is very temporary, and I think we will actually go a little lower and perhaps go into the 120 to 122. That's where I think a lot of shorts will start to cover, but for right now, I think market participants are still bearish the market, at least on a macro basis. So nobody's that optimistic about Europe. And let's be realistic, I wouldn't be either. And we're seeing the same type of, and we're also seeing limited upside in the equities, as equities could at least go up to around 12,800, 12,700 at most, giving us perhaps 3% upside. In fact, a lot of options are pricing in limited upside, but a lot of downside. In fact, when you look at the options calls and puts, people are spending more money to buy, people are spending more money buying into downside than they are buying into upside. So that means that people are more optimistic, people are more pessimistic than optimistic just based on option valuation, because the amount of money people are willing to buy for upside is substantially less than what people are willing to pay for downside protection. Basically, people are willing to spend more to buy put options than they are willing to buy call options. And even the spreads, the callers, they're not that appealing, because you'd have to buy perhaps 5, 6 levels down before you could actually get, I guess, a decent spread. So, perhaps maybe if you sold a call option at 135 SPY and you bought a put option at 120 SPY, basically the main point here is people are willing to spend more to hedge their losses than they are willing to speculate on future upside potential. So that means the stock market has future limited upside potential overall. The charts say it, but the options market is saying it as well. I can't go into specific examples because I don't have enough time in this video, because I do need to talk about silver and gold. Silver is breaking out of this channel. Chances are it could continue this uptrend for the rest of January. If it does, I would start closing out somewhere around 34. Even if it doesn't get up to $34 per ounce, I would still close my silver long position, mainly because of the fact that risk appetite is only elevated for a certain period of time. And right now, the main driver for why stocks are going up is earnings and the pump and dump that's associated with earnings. Once earnings are reported, a lot of people will dump their stocks, and risk appetite will decrease. When risk appetite decreases, I think silver and gold will go along with it as treasury bonds continue to get bid up. And only certain treasury bonds, which means the US, Japanese, Singaporean treasury bond markets, stuff that has AAA ratings. As far as gold is concerned, gold is trading in a range right now, and it's reaching the upper end of the pennant pattern or pennant formation. Again, when I look at this pennant formation, the main point I want to bring out is, how much upside could it really break above 1700 and the upper ends of that pennant pattern? If it does, there might be further upside until 1900, but by the end of January, could we really break above 1700? That's what I'm not too certain of that. There's limited risk appetite going into gold. Some people think that gold has returned as the reserve currency, the next global standard. I don't think so. There's a lot of flaws with gold as far as a currency standpoint. Is it an alternative currency? Maybe, depending on the perspective. But overall, to me, my main alternative currency is the Japanese yen. That's where I would put my money, at least until Europe settles its debt issues and Japan starts having issues of its own, where they have a hard time, financing their debt, and maybe we'll see Japan being the next iron horse, where they're in trouble and Europe is not, and therefore the whole entire European-Japanese yen trade would reverse upon itself. So we'll just give it some time to play out. But I still think the European-Japanese yen pair is still on a downward trend, and I would definitely choose the Japanese yen over the euro, over the US dollar any day, at least currently. Sears Holding was able to get a nice little bounce off of its 2009 lows, but I think there's limited upside, and I think the highest it could possibly go is the 20-day moving average, which sits at around $40 to around $38 on the gap fill area. So anywhere between there is perhaps the maximum upside, but if risk appetite really gets to a point, perhaps it could go all the way up to $45 per share, but the likelihood of that is slim, and once the dump starts to set in, I am definitely going to short Sears Holding. So again, just give it some time. Markets will pull back, and when they do, Sears Holding is definitely a target. Bank of America has limited upside. However, I still think it will trade up to $10 per share. And right now, the tangible book value of Bank of America sits at around $14 per share. It's trading at $6.86 per share. So we got $7 margin of safety. That does it for me for today. Take care, folks.